Mark Selby, Chair and CEO of Canada Nickel, advancing the Crawford Nickel project and unlocking the Timmins Nickel District.
You are. And with today's news, we've kind of got a sense of how you're going to do it as well. So congratulations, Order. Is it the deal you wanted?
Yeah, no, major milestone happening here. We've got, we're the first big bulk tonnage deposit to have a major mining company invest in the story. So we've got Anglo American at 9.9% shareholding. So, that's great. It's the right size.
Yeah.
Gives us the money we want, gets the endorsement investor, but doesn't put them in a blocking position, that would take out some of the auction potential, for the asset in the future.
Well, yeah, in fact, on the show, we've talked a lot about competitive tension. You can't put yourself in a position where, two things happen, where you've kind of got a majority shareholder which kind of shapes and defines your future and perhaps restricts your future optionality. What does the deal actually look at, and how much control do you retain?
Sure. So there's no board seat now. If they get to 15% in the future, which they would have to do by buying more stock in the market, at that point, they're able to get one board seat. Right now, they're getting a seat on our technical committee, because a key component of this deal is they've got some technologies that they think can add a lot of value to Crawford. So we're going to be providing a bunch of samples to them to be able to do that work.
Right.
And again, all of us will benefit if these technologies that they've got will unlock an additional value as well. There's an offtake component. But again, this is an offtake that's strictly at market terms, not giving up any economic value. They're just going to basically manage the flow of those goods for just 10% of our production for the first, should be for about the first 15 years. So 65,000 tons of nickel out of, what should be feasibility study, 1.5 million tons. So not a very large portion of our offtake over the life of mine. And I think, what's really important as well too, is not just the nickel cobalt, it's the iron chrome product, and the carbon credits. So, the fact that, those are two components of value that, we've talked about. People go, well, I don't know if this is, this stuff is for real, who's going to want this iron chrome product? But the fact that they've included this as part of the transaction, I think should be a signal to people that it has value.
The kind of the construction of the conversation is what I'm interested in. Yeah. To go and get a company like Anglo interested, it's not easy. It's not. Most people don't do that, and they do look around and take options on a few projects here and there. But to get them over the line is great. But there's a few new components here. It's not just nickel. The iron chrome, and the carbon credits, right, and the carbon capture component. We'll throw that in the mix as well. So, which part of Anglo is it? Is it?
Yeah, so it's basically with they have a group that basically does marketing that they've set up to do some of their investment in smaller scale companies.
Right.
But we're working with that group, and then we're working with their Future Smart Technologies group.
Right.
So and again too, some of their technologies, they want the if we do use their technology, they want the offtake for the incremental, which makes sense. But again, the incremental for the nickel, and the incremental for the carbon credits. So again, if people are skeptical that this rock, it's for real, and these guys are making investments.
10% offtake on the regular. 100% if they use their technology to extract incremental value. We'll call it. So let's bring it back to basics. Money. So how much money?
$24 million.
Is that enough to do what you need to do this year?
This gets us through a good chunk. We may need some more money later on in the year, but again, we're having these conversations, with the Koreans right now in terms of offtake.
Right.
And again, if people should realize that these discussions take a long time, I think sort of, our initial conversations with Anglo were, 18 months ago, and
really?
That's when, to start to do the dance, get serious about it, then negotiate the terms, and then get to a point where, we can announce it today.
Well, let's talk about that, because you had a few people kind of, because I think we talked not quite sure when last year, but the beginning to middle of last year, about, wanting to bring in strategic partners, right? To kind of help you through the economic phase, but also give you credibility as well as a balance sheet and actual cash. 18 months conversation, 18 months with Anglo. You've been talking to Koreans for a long time. So what is the kind of process look like? Because I think most people looking at the junior space expect it happened overnight, right? It clearly doesn't.
No. Oh, no. Again, I work for Inco. We had very good long-term relationships with, companies in Japan, companies in Korea, elsewhere. I know that those things don't happen, with 2 meetings in 2 months. It's basically, it's creating a relationship, right? It's forming the base, forming the base of a relationship that you can then form a business transaction on top of.
Right.
And those things take time. So, we've been sprinkling the seeds for a long time. And so, again, the other thing I think that's important about these deals is, a lot of times the conversations, people don't move quickly unless they start to feel a little competitive tension, a little competitive pressure.
Right.
So all of a sudden, with this one deal now that, okay, 10% of the capital, 10% equity stake's gone to someone, 10% of the off-take's gone to someone. Oh, I'd like to have a stake. I'd like to have some of the off-take.
Right.
And now it's starting to disappear a little bit. I think that'll help, speed up and put some pressure on the other conversations that we're having.
Right.
And then we're going to be working with Scotia and Deutsche Bank again to now that we're sort of far enough along to put a whole process together to start marching these people towards an end goal, which we were hoping will be sometime before the end of the year.
Okay. So Scotia and Deutsche Bank obviously will kind of talk to the broader market in terms of strategic investors. Why?
Oh no, they'll be talking to the strategic investors.
They'll
be
do that
yeah.
as well.
Yeah.
Okay, so there's not a president's list. We got this covered.
Yeah.
They're going to all of market.
Yeah. So Scotia, again's got a great mining franchise. That was the key piece there. I mean, Deutsche Bank, obviously does as well. But where Deutsche Bank really brings is, they've got a whole global industrial franchise, right?
Gotcha.
And we're talking about car companies globally. We're talking about, battery supply chain companies globally, right? So bringing them both together, was a perfect fit from our perspective.
Right. So the other thing that you promised at the end of this year, which has been delayed, and we talked last time about why, is the feasibility study. Right?
Yeah.
So $24 million gets you said, so
good chunk
far,
of the way through this year.
Good chunk of the way through. Yeah. So remind everyone now, because it's a new show, new interview.
Yeah.
Timing of feasibility study is when?
It's going to be mid year, end of Q2.
Okay.
Yeah.
Right. And that's to include the carbon capture, carbon credit component.
Yeah.
I assume the money that you just picked up will allow you to kind of get to the feasibility study.
Yes.
We're good on that, right?
Yeah.
So that's the deadline. No new deadlines.
Yes. No new deadlines. Yeah.
So following that, I think you're intimating that there will be more money coming in, and you'll let us know how and what shape and how much.
Yeah.
What's that for?
That'll basically be, again, we're building a real project. So, we kicked off a permitting process last summer. There's a bunch of milestones that have happened. This year, when you end up filing your environmental impact statement, that's a big chunk of work, and there's a whole pile of dollars in terms of test work and engineering that need to go into that environmental impact statement. And so, that's another sort of, work stream that needs to be financed. And then again, once feasibility study's done, that you can't take that and start, give it to a construction company and say, please build a project.
Yeah.
You need a little more detail than that. So, again, based on the amount of financing available, we'll do more or less detailed engineering to continue to lay the groundwork so that, the day that we get the permits, that we're ready to, hit the button on construction, and that's why on the financing side, we've got, again, Scotia and Deutsche Bank on the equity portion of the project financing. And then we'll be appointing in the next month or so a project debt advisor. There's a handful of companies that do that. We, past life with RNC, with Dumont, we work with Rothschild, for many, many years. Again, Rothschild, doesn't work with just anybody, and again, sort of they work for good projects and good teams. And again, the people we're going to be working with in terms of the debt side, again, there's a handful of people who do billion-dollar type project debt finances, and we'll be working with one of the leading companies, on that front.
So I think we've seen enough companies come through here. So when they announce they're going to be working with finance companies, I kind of go, that's great, but I don't care.
Right.
The bit that I think today brings is a bit of credibility. Anglo, they've got choices, right? It's also, they'll have done some diligence. You don't splash the cash without doing that. So, and they've got a technical team who are capable of doing that, and also want to work with you technically going forward, right? So I think that's a massive endorsement thing. What do they think? Because this is one of the things thrown at your company, thrown at you all the time, and companies like you all the time. It's like, such low grade. Why would I work with a low grade nickel company like this?
Right.
So what's important to them?
No, they basically see a large, high margin, multi-decade resource base that's sitting
high margin. It's low grade. How's it high margin?
Yeah, no. Again, just if you read the PEA, you're looking at 60% operating margins, over the life of the mine.
Right.
And again, go look at what BHP, Rio Tinto's, Vale's operating margins are on some of their, and they're around that number. So people really need to. Grade is just a number. You really need to look at, revenue, operating costs, capital, and look at what that overall equation looks like.
Right.
And again, big guys who build big multi-decade projects, they're not scared by the kind of scale that we want to start at. They're not. They like the fact that it's a multi-decade resource with lots of exploration potential.
Right.
And they 100% get the fact that we're sitting in Timmins with a pile of infrastructure around the project, and we're not some new copper discovery up in the Andes with no water, no power, no people, and no infrastructure. So which is a lot of where the new other base metal deposits are out there today. So
okay,
yeah.
So, but let's talk about that. So, if you don't mind, because it's just like you're kind of getting to a really exciting phase, right? You kind of like you can talk about the Lassonde curve if you want to do that, turns you on, but it's that whole conversation around low grade versus and high capex, right? That's the things people go, oh man, it's $1 million, $1 billion, it's $2 billion, whatever number, right? And it's such low grade, this won't work. The word you use there, which I think is important, and I'd like to understand better, is this margin component, right? And I think you're a little bit casual there about saying, look, it's easy. What are the factors that influence your ability to create a 60% margin type project with such a low grade, ore body? Yeah.
So one, it's just the resource itself, so that you can operate at a scale.
Right.
So we'll be starting, in the feasibility study, at 60,000 tons of ore a day, going to 120,000 tons of ore a day. So that just brings your unit costs down.
What does that mean? You took some numbers.
No. I mean, at the end of the day, when you have a mill, you basically have the same number of people in a mill, whether it's 1,000 tons a day or 120,000 tons a day.
Right.
So, having that scale, really brings you down the unit cost.
Right.
Unit cost element pretty dramatically. The other big driver is just where we're located, in Ontario. So we have access to pretty reasonable cost power. That's also low carbon, so that allows us to design in a low carbon footprint. We've got all this infrastructure in place. So, we're not at the end of this 200-kilometer road, where we're going to have to truck diesel in and truck reagents in. We've got a rail line that already exists just 15 kilometers south of the thing, and we'll bring that right into the mine site. So we can bring in all of the bulk supplies we need by rail. So again, that's another big chunk of cost component. And then the other part, that people don't pay enough attention to is we're fortunate to be in a place where we have 60,000 people in several communities that are less than an hour's drive to the mine site. And in Ontario, people are happy to in Northern Ontario to drive an hour to and from work.
Right.
That's not an issue at all. So we'll have a residential workforce. We won't have any of the fly-in, fly-out costs that you have to put on top of the labor. And then, once you're in the fly-in, fly-out pool, you're competing with every fly-in, fly-out project, across the country. And so having a residential project, next to a nice city like Timmins, is a massive benefit in terms of having a productive, much lower cost workforce. So when you stack those things together, that allows you to get to an operating cost per ton. That makes sense. And again, very simply, we start out mining $30 a ton rock plus or minus. Costs are $10 to $12 a ton during that phase.
Right.
Then we ramp up, and then over the life of mine, we're looking at $20 to $25 rock with $8 to $10 a ton operating costs.
Okay.
And again, just go benchmark ATIC and Boliden, go benchmark the big copper porphyry projects in Western Canada, and those numbers, for smaller operations are in line with what we're talking about from an operating cost perspective.
So the OPEX component is the kind of secret sauce here, and the fact that it's multi-decade. So your sunk costs up front in terms of CapEx, amortized over the lifespan. That's what's attractive for these big companies.
Yeah.
For you. It's not a 10-year life of mine right now. We need to find something else.
Yeah.
We're here for 30, 40 years.
Yep. And you've got the optionality from the expansion potential of doing stuff in the future. And again, for big companies, that optionality, is something that's worth some significant value to them.
Right. Okay. So for this year, I'm trying to sort of get people. Obviously, we talk on a weekly. Battery show about the world of nickel and what it's doing in terms of pricing and so forth. Last year was a kind of funky little year for it. And I think most companies were off in terms of equities because that's what the market was doing. I think there's a little bit of enthusiasm. Certainly when we've been around talking to people in Darwin one-to-one here, people are excited about 2023 and what it could deliver in terms of commodities. So that's all good. Back to Anglo. Because that's the big news of the day. Anglo, what are they calling? I think it's the Anglo. What's the technical team?
Future Smart Technology.
Future Smart Tech. What a great name.
Yeah.
Anglo American Future Smart Mining Team. Okay. Yeah. They want to use their technology and they want to kind of help with the kind of efficiencies of the project because that's where they're going to understand their margins a bit better. Is that going to delay anything with you? Because you've included this kind of carbon component, and you say, look, we need to do this because once we understand how those economics work, it dramatically changes our understanding of the economics of the project. So we delayed this. Anglo American's involvement with their Future Smart team is not going to delay things.
It's not one single day. We are driving onto the same schedule that we have. And again, that was something we very definitely wanted to make sure. From day one, we've been aggressively advancing this project forward. To go from 5th drill hole to less than feasibility study in less than 4 years on what'll be the biggest base metal mine in Canada. Is an outstanding tribute to our team. And the ability to operate, advance things in parallel and be able to push like this. And so, the Future Smart technology applications are all about, potential additional value that could come in, but that won't stop us from, advancing our core project.
Right,
as long as it continues to be owned by us.
Okay. So, and just sticking with this a bit longer. So, with Anglo American's team, obviously they're looking to see efficiencies in terms of reduced emissions, right? So, they're dealing at the front end. You've also introducing this component of the carbon capture at the back end. So it should be a very appealing project if people are allowed to use the word ESG anymore, or net zero carbon, because I think people are so tired of people throwing these around with no real substance behind it. So is that kind of the biggest sort of attractive draw to them in terms of their ability to bring, save the money up front, but also in terms of emissions, but your ability to then maybe negate that across their group, not just with the futures team?
Well, again, it's the, adding some EV metals to the portfolio, expanding the production. They already operate in nickel today, right? And then again, having on an ESG basis in terms of the jurisdiction, in terms of the location, and in terms of the carbon footprint, it's check, big check, big check, big check.
But really, it's about, we got a whole bunch of nickel here. Iron chrome, which we really talked about a long time ago. But you put that in the press release a few places, so that was meaningful to them.
Oh no, they wanted 10% of the offtake of all the various metal products. And again, iron ore and chrome in the PEA, we talked about, taking all of that into the stainless steel industry. At the end of the day, we would be the only chrome producer in North America. And chrome, chrome is a high carbon source of, again, it's one of these metals where it's made here in South Africa. It's made in a few other places, and you use a lot of carbon to be able to smelt ferrochrome. So for us to be able to offer a low carbon chrome product is something that's very effective. That's why we're working with Marcus Moll and his team in Austria. And again, having those kind of conversations with some very big companies around being able to use that feed and look to process that materials somewhere in North America to be able to provide a low carbon feed of both iron and chrome.
So with Anglo American coming in, what's the price? It came at $195. Common shares. Right? You've been as high as 4. So it's kind of like, well, we are where we're at. It's all concerned around the timing of this. I know you've been talking about it a long time. You're probably talking about it when they were at around $4. Right? I guess.
No, we've those conversations have, we've gone from $3-4 down to $2 and back up and down once or twice. At the end of the day, it's a premium to the 30-day VWAP. So that's
But
that's
the mile is frustrating to you, and I know you talked about your family wealth thing. It's as frustrating to you as it will be for a lot of retail shareholders, I suspect, in terms of the timing. But you're saying it's about what that money can unlock for you going forward. You will.
Oh, and again, being the first of the bulk tonnage projects to get an investment from one of the major mining companies, is a massive endorsement, right? So again, there's a lot of, fund managers, investors who still, don't quite get the economics of this bulk tonnage. Again, I don't think it's that complicated, but, this will make it easier for a lot more investors to step into the story. So,
but I think the institutional guys, and I was one, they will be looking at the grade thing. And they were looking at bulk tonnage. And they say, it's therefore marginal.
Right.
You were talking about margins, 60% plus. And the economics can improve possibly with the carbon component. So I think it's almost like you need to stop talking about grade and you start talking about margin. therefore, maybe the narrative changes somewhat. So that's what I picked up today. That was interesting to hear that word margin come into the conversation. Right. So, and finally, just finish off because I'm really trying to wrap my head around and understand the timing of this, because obviously it seems good value at the moment. He's just stepped up to the plate. But there's the second tranche of money, or the next tranches of money to kind of get you further along the line. Will that be another strategic investor? I know Anglo have got a bunch of options here, and depending how things go, but you may not want that, and you're in control of that at the moment. So you're looking to raise that kind of competitive tension.
Oh, 100%. I mean, we've got discussions with the whole EV supply chain, and it was just in Korea last week. Again, we're talking to, again, we've got a portfolio of 20 plus properties. Again, with what we've done at Reid, what we're picking up at Texmont, there's a whole number of ways for different people to come in and for us to raise capital that doesn't necessarily, dilute Crawford. So, again, between now and the end of the year, when we may need some more money, any one of those levers could come to the table.
Right. But what does that look like? Again, the uninitiated, worry, more dilution, more dilution. It's a nightmare, right?
Yeah.
But the reality is, you're starting to do structured finance now.
Yeah.
And the type of money is more important than the amount of money.
Yeah.
Right.
Right. So we can bring in assets into specific assets. We can bring money into specific structures around certain assets. Right. We could joint venture certain assets.
Gotcha.
So
one bit would be sitting down here at asset level potentially. As a way of doing that.
Yeah.
And obviously offtake, you'd never count it as a royalty if that's possible, was it?
No, not on Crawford. Crawford's already, Franco-Nevada has it's 2%. And that's as much as you want, and Franco-Nevada's got that one. So, but on some of the other properties, we've got room on the other regional properties. So, that's something that's potentially monetizable. But at the end of the day, look at our share count. We are 5 months away from completing a feasibility study, and we've got a share count of 120 million shares. Look at some of our peers have 700 or 800 million shares. Some of our peers have 250 million shares, and a full feasibility study isn't even on the horizon for most of them. So, in terms of giving people the maximum nickel torque per share, the maximum future cash flow per share, we're 100% focused on that. So you can be assured that, anytime we issue shares, I'm extremely cognizant of, that managing that dilution, to the minimum amount possible with having as least risk to the balance sheet, as possible. So.
Good announcement today.
Thank you, sir.
Thanks for coming in and saying us.